The $5,000 DOGE check. Should you expect it in the mail anytime soon? Hello, members, super savers, and bond course fans. I hope you're healthy and well, and welcome back to our weekly update. The $5,000 DOGE check has been all over the news the past few days. But here's the million-dollar question, or rather, the $5,000 question. Is this really confirmed, or is it just a pipe dream? With that in mind, here are the three topics that we'll be covering in today's video. 1. The $5,000 DOGE check. What is it? Who might qualify? And who gets left out? And specifically, I'll be talking about the economics behind it and whether or not you should expect to see that money anytime soon. 2. Which treasuries rose the most and which ones fell this past week? And 3. What are the yield expectations for the upcoming week's treasury auctions? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? And yes, my background is a bit different today. School was off this week in our area, so we were away for a few days. And while I did bring some of my trusted taping equipment, I couldn't bring my bookcases with me. In any case, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. The $5,000 DOGE check. What is it? Who might qualify? And who gets left out? As many of our Diamond NestEgg regulars already know, DOGE stands for the Department of Government Efficiency, a cost-cutting initiative led by Elon Musk and aimed at eliminating wasteful federal spending with an initial goal of $2 trillion in spending cuts. So earlier this week, James Fishback tweeted on X, President Trump and Elon Musk should announce a DOGE dividend, a tax refund check sent to every taxpayer funded exclusively with a portion of the total savings delivered by DOGE. Now, we hadn't heard about James Fishback before this, but it seems that Fishback is based in Florida, founded investment firm Azoria in 2023, and according to Yahoo Finance, is expected to launch a new anti-woke ETF in the first quarter of the new year. So this quarter, basically. And talk about good timing, the new fund's name is the Azoria 500 Meritocracy ETF. In any case, the premise for Fishback's $5,000 DOGE dividend tax refund check is that 20% of the savings achieved by DOGE should be redistributed to tax-paying households. The math behind his $5,000 DOGE dividend is fairly straightforward. DOGE's goal for spending cuts is $2 trillion. 20% of these spending cuts is $400 billion. Divide this by 79 million tax-paying households, and we get to a DOGE dividend per tax-paying household of roughly $5,000. The idea has gained traction among certain policy and decision makers, it seems. From Forbes, Elon Musk confirms Trump DOGE dividend check support. So, assuming this actually happens, which is a big assumption, but more on this shortly, who would be eligible to receive the money? It's still early days on this one, but in a nutshell, based on the Fishback proposal that has been making the rounds on this $5,000 DOGE check, you would need to be a tax-paying household, which brings us nicely to the reasons why the $5,000 DOGE dividend may not be a shoo-in in real life. Reason 1. Most tax-paying households who would receive the $5,000 DOGE tax refund would be moderately high to very high earners, based on this preliminary proposal. According to the Tax Policy Center, based on numbers from 2022, which were the latest that we could find, of the households that earn less than $10,000, 99.9% did not pay any federal income tax. And of the households that earn between $10,000 and $20,000, 93.1% did not pay any federal income tax. Even amongst the households that earn between $50,000 and $75,000, about 30% did not pay any federal income taxes. Only the households that earned $100,000 or more did basically all pay federal income taxes. So if the DOGE refund checks would be distributed as a refund to federal income taxpayers as Fishback proposes, then by design they would be sent to the better off half of the country only, which may prove a bit tricky, politically speaking. Of course, if the DOGE dividend concept picks up steam, the administration could modify the proposal to include an income cap, similar to how past stimulus checks during COVID were phased out for high earners. But this might defeat the tax refund gift wrap that Fishback has put around the idea. Moving on to reason 2, The $5,000 DOGE tax refund is based on $2 trillion in total DOGE savings. This $2 trillion savings goal has been thrown around for quite a while, but at the beginning of this year, in the Wall Street Journal, Elon Musk already stated that DOGE's goal to cut $2 trillion in spending is a best-case outcome. Nonetheless, it seems that DOGE is still sticking to the ambitious $2 trillion savings goal on the DOGE Live Tracker, which also quotes over $50 billion in DOGE savings at the time of this taping, close to 3% of the $2 trillion savings goal. Some media outlets have quoted savings that are significantly lower than this number here, though. The point is that a $5,000 tax refund for every tax-paying household, based on a $2 trillion DOGE savings target, which even Musk himself considers aspirational, may be a bit of a stretch, and even in the best case, may take some time to materialize. Reason 3. Even if the $2 trillion in savings were realized, Congress would have to prove how the money is used. This could take a long time, and it's unclear whether sending some of those savings off to tax-paying households would be the best use of funds. Listen, we are a tax-paying household, and I would love to get an extra $5,000 in my bank account from DOGE. But if we're really in a savings frame of mind as a nation, a better use of that money might be to reduce our deficit and or pay down at least a part of our national debt. Reason 4. Injecting hundreds of billions of dollars into the economy could further drive up inflation, which is already a concern for policymakers. Now, Fishback's preliminary proposal states that the DOGE dividend wouldn't be inflationary because DOGE dividend checks are exclusively funded with DOGE-driven savings, unlike COVID stimulus checks, which were deficit financed, and DOGE dividend checks are sent only to tax-paying householders who have a demonstrated propensity to save, not spend the incremental dollar received. There are some statistics quoted here to support this point from a 2019 CNBC survey, but personally and professionally, our experience has taught us to remain careful with such general assumptions. I've spoken to too many clients and non-clients during the pandemic who received a stimulus check that they either didn't expect or didn't need, or both, and that money generally ended up spent or invested in the stock market, both of which tend to be inflationary. And finally, reason 5, why the $5,000 DOGE checks might never be sent out. While Trump and Musk have said they like Fishback's idea, it's at this point not really clear how high on the administration's priority list the proposal is, and how much political capital the president may want to spend to get the idea through to actual implementation. This is not a COVID-type emergency where everyone wants to be helpful, so the political battle might be heated, and maybe too heated for the administration's liking to push it all through. Like for so many of the other ideas being floated currently, it's probably too soon to know, and only time will tell. So, where does this leave us? In my mind, the $5,000 DOGE check is a nice political talking point and good marketing, especially for DOGE and for Fishback, who is about to launch his new ETF, as I mentioned before. But the $5,000 DOGE dividend looks very far from actual implementation and is not something any of us should bank on at this point. Could it happen? Maybe, if the government actually succeeds in cutting $1 or $2 trillion in spending. Never say never, right? And I personally would welcome the savings, given where we stand with our national deficit and debt load. But realistically, there are too many obstacles and too many assumptions, and probably also too many conflicting priorities for the DOGE tax refund check to materialize in a meaningful way in the near future. But Fishback's proposal does raise an important question. If the government finds ways to reduce waste, should those savings go directly back to taxpayers, or should they be used elsewhere first, such as to reduce our ever-growing deficit and debt pile first? Drop a comment below and let us know. Now, let's move on to the next section of today's video and see how the latest political and economic moves impacted bond yields this week. Which treasuries rose the most and which ones fell this past week? As we so often do at the end of the week, let's grab our rates from the Treasury's daily Treasury par yield curve rates page and compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Our Diamond NestEgg regulars will notice this new 1.5-month column here. This represents the brand new 6-week T-bill, which had its first ever auction this past week. Drop a comment below. Did you pick up any 6-week T-bills at this past week's auction? So, here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. And here's the increase or decrease in rates over the past week. Increases in rates are shown in black, and decreases in rates are shown in red. Treasuries across nearly all maturities ended lower than the previous week, with the biggest drop seen in the 1-year T-bill at minus 8 basis points. The 2-year through 20-year yields did not fare much better either. This was primarily driven by 3 key factors. First, data for the services PMI came in below expectations. Services PMI is the Purchasing Managers Index for services that companies buy and is reflective of the strength of the U.S. services sector and the overall U.S. economy. Second, consumer sentiment was also down as long-term inflation expectations continued to increase. And third, the pace of existing home sales declined in January 2025 due to elevated mortgage rates and probably also bad weather. In addition, Walmart, which with its overall revenue of $681 billion for the last financial year, is considered the largest retailer in the US and the world. Walmart lowered its earnings forecast, raising even more concerns about US economic growth. So all in all, not great news for bond yields this week, especially against the backdrop of the new administration's ongoing tariff announcements. In fact, it's not been great news for bond yields this year so far at all. Let's take a look at Treasury yields from this past Friday versus the beginning of the year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd of this year. And this row shows the increase or decrease in rates in 2025 so far. Again, increases in rates are shown in black and decreases in rates are shown in red. The 2-month, 4-month, and 6-month are slightly higher than where they started the year. The 1.5-month or 6-week was just launched, so not much to say here. All the other maturities, however, are down since the beginning of 2025. And if we consider the direction yields have been moving on the long end over the past few weeks, further and further down basically, it does appear that the yield curve seems to be slowly re-inverting again. Now, we don't technically have an inverted yield curve yet. The 10-year still pays more than the 2-year, and the 30-year still pays more than the 1-month. But it's definitely a U-shaped yield curve where the middle maturities pay less than either the short end or the long end. This may not be so different from an outright inversion, with some extra concerns and worries adding a higher risk premium onto the long end. So as I just said, not great news for bond yields so far this year, and it could all point towards a more pronounced slowdown or even an outright recession ahead of us if the trends continue. And as an aside, the winter vacation spot where we're currently staying, I mentioned my different background from before, it does seem to be a bit less hustling and bustling than during the same President's Day weekends in the past few years. Even our favorite local sandwich shop has much shorter lines than we were used to. In fact, most lines were shorter overall. Of course, that's just our personal observation and may or may not be relevant for the big picture, but it does seem to fit with what the Treasury yield curve tells us. Be that as it may, it is still early days, so as customary, we will continue watching the markets and the economy and keeping you informed here at Diamond NestEgg. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's Daily Treasury Par Yield Curve Rates page, as I mentioned earlier. All sources are linked below in the first pinned comment. Do keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. Now that we've covered Treasury yields from this past week, let's move on to the next section of today's video. What are the yield expectations for the upcoming week's Treasury auctions? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill auctions are happening as usual. And if we scroll down further, we can see the 2-year, 5-year, and 7-year T-notes will be auctioned off as well this upcoming week. None of these are reopening auctions, so the coupon is still to be determined. Also on the schedule is this 2-year floating rate note. At the time of this taping, on Fidelity's platform, here's what the coupon and the expected yield are for the 2-year T-note. Here's what the coupon and the expected yield are for the 5-year T-note. And here's what the coupon and the expected yield are for the 7-year T-note. Do keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. So that was Treasuries. For those of you who may be interested in other types of bonds and CDs for a bit of a higher yield potentially, here's where the highest yielding new issue agency bonds stand at the time of this taping, with the highest yielding one from Federal Farm Credit Banks at 5.86%, just like last week, with a first call date in February 2026. Here's a CUSIP for those of you who may be interested. For corporate bonds, the list is quite long again on Fidelity. Here's where the highest yielding new issues stand at the moment, with the highest yielding one again from Deutsche Bank at 6.1%, with a first call date in February 2027. Here's a CUSIP for those of you who may be interested. For brokered CDs, the highest yielding ones stand at 4.6%. These ones here have first call dates slightly further out in August 2025. If you know of any bank CDs or high-yield savings accounts with particularly attractive rates at the moment, then please do drop them below and let me and the community know. All right, members, super savers, and Bond Course fans, I hope you enjoyed this video and learned something new. And as always, if you want to build other sources of stable, predictable income in retirement, especially while bond yields are still quite attractive, then check out this video here on our beginner and intermediate bond courses. And come join our next live member Q&A this weekend on Sunday, February 23rd at 5 p.m. Eastern Time, 2 p.m. Pacific Time. We'll be diving deeper into this month's 2-, 5-, and 7-year Treasury auctions and all things fixed income. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. And for those of you who also subscribe to Your Financial Journey, this latest video from Caitlin may give you some helpful ideas for the teens in your life who are looking for the best summer jobs this year. And this latest one from Ava takes a look at capitalism versus socialism from the lens of the Lammer family, the pros and cons of each system, and which one is better in our mind. So good luck to everyone who's planning on picking up some bonds and or CDs this coming week. And see you again very soon with more brand new wealth building content for your financial journey.